Happy Monday out there, Team 42. It's your skipper here, Darius to present our macro minute for Monday, December 23rd, 2024. Hope everyone's enjoying a wonderful holiday season with their family. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So, today's key macro question is: how inevitable is a too strong US dollar? Part two. Our answers are: there are several probable economic and policy outcomes that are likely to support the current uptrend in the US dollar over the medium term, including but not limited to number one, widening interest rate differentials, number two, tariffs, and number three, Doge. A wild card in our long-term dollar bull thesis is the likely $700 to $800 billion of Treasury General Account spin down that we currently expect to occur amid a debt ceiling impasse early next year. That outcome should be dollar bearish and support risk assets through late Q1 or early Q2. Beyond that, the replenishing of the TGA amid excessive global refinancing demand may contribute to a global refinancing air pocket that will be akin to borrowers playing musical chairs with the limited dollars of available balance sheet capacity. It is also likely that incoming Treasury Secretary Scott Bessent has shifted U.S. net financing policy in a hawkish manner by then as well. Refer to the left tail risk sections of our December 2024 macro scouting report, as well as our November 30th, December 7th, 14th, and 21st Around the Horn webcasts for the institutional grade analysis supporting these conclusions, as well as the implications for your portfolio. Transition to our 42 macro dashboard here. As always, we'll wrap up with a question from our community. This one's regarding fake QT versus real QT. It says, hello, DD et al. What is the when the Fed started reducing its balance sheet that is supposed to drain liquidity from the monetary system? I'm assuming the Fed can does this as a way to curb inflation while also raising the interest rate. Is this fake QT because they were not hawkish enough because asset prices skyrocketed, GDP was good, unemployment was low, and they bailed out the banks again? If it were real QT, the Fed balance sheet would be somewhere below where we were a few years ago, and asset prices would grow more slowly, around 10% per annum. GDP growth would be lower, unemployment would be higher. Am I understanding real QT and fake QT accurately? Excellent question. One of my favorite topics. Grab a beer and talk about macro topics. At 5 p.m. Is a sort of concept of fake QT versus real QT. When we talk about, so this is a great question, and the spoiler alert is that this is the client's sort of interpretation of the outcome of fake QT as it relates to a more resilient economy, very buoyant asset prices, very resilient labor market. Those are the outcomes of implementing fake QT. But what fake QT actually is balance sheet runoff. And so if you recall, like when the Fed does quantitative easing, it's actually expanding its balance sheet to acquire securities from the secondary markets in order to enact monetary policy to create balance sheet capacity for the global private sector, whether it be banks or non-banks, so that they can lever up and buy more assets and keep the system going. When the Fed does, so in theory, if buying the assets from the private sector is quantitative easing, then we should surmise that quantitative tightening is selling assets to the private sector. Well, the reason we call it fake QT is because the Fed has not sold any bonds to the private sector. The Fed is simply allowing Treasury securities that are maturing to roll off its balance sheet, and rather than repurchasing those securities in order to maintain the same size of a balance sheet, it's just allowing its balance sheet to gradually shrink as a function of that process. Even if the Fed wanted to maintain the same size of the balance sheet, it can't do that in a static way. Like if you own a bunch of 10-year Treasury securities, 10 years from now, those 10-year Treasury securities will be, zero DTE Treasury securities. And once they expire, the balance sheet will shrink otherwise, unless you, of course, unless the Fed, of course, bought incremental Treasury securities in that regard. So the Fed can't just maintain a static balance sheet in the context of a fixed income market that is obviously structured across various tenors and durations. And so when the Fed does fake QT, aka balance sheet runoff, all it's doing is saying, okay, we're allowing this Treasury security to roll off our balance sheet, but we're not going to replace it in order to maintain the same size of balance sheet. So we're going to gradually allow our balance sheet to decay. And so, in our opinion, this is a step in the hawkish direction, but it's not exactly a particularly hawkish thing, and especially in the context of what the expiring debt debt, the expiring piece of treasury paper allows for the rest of the private sector. As the treasury paper expires, then obviously, unless it's being replaced by the fiscal authority, which of course it is, we're running a budget deficit. But in isolation, if it wasn't being replaced by the fiscal authority in terms of new borrowing, then you would actually be creating liquidity in the private sector. But again, that's not the condition now, because again, we have these massive fiscal deficits as well. So the key takeaway is that because the Fed is not selling bonds to the market, it did not tighten financial conditions nearly as much as you would think it would in a quantitative tightening scenario. And as a function of that, we've had a significantly more resilient economy, more resilient labor market, significantly buoyant asset prices as a function of all that, and other dynamics as well, right? It's not the Fed's balance sheet is not the only reason the economy's been resilient. There are a lot of reasons why the economy is resilient that are irrespective of what's happened on the Fed's balance sheet. So I want to make sure investors are well aware of that. And one final thing, just transitioning, I got another comment from our community here. This one, we'll just wrap up here because we're heading into Christmas. We're going to be offline on Tuesday through Thursday of this week. So next few days, celebrating the Christmas holiday with our families here at 42 Macro. We appreciate you guys for giving us that time to do that. Just want to wrap up with this because this is a phenomenal comment, and I think it's a very appropriate to begin the ending of the year on. And it just says, "quote Better keeps getting better." It says, Darius, I followed you since 2015. When you were on the other show, I always liked your presentation much better for my purposes than the full-time host. Your information and clarity of message continues to get stronger. For a retiree that has not wanted a daily blast, the weekly Around the Horn product is spectacular. Thanks for all your hard work, and best to you and the team in 2025. So I just want to say thank you to this client. We appreciate the really kind feedback. We're working really hard to create some really positive outcomes in our client portfolios. And this has been the third consecutive year which we've done that. Recall that we were appropriately bearish in 2022. We were appropriately bullish in 2023, and then we were ragingly bullish here in 2024. And as you can just pull up a chart on any asset market, you could tell that those were all the three best calls you could have possibly made for each of those years. So we're looking forward to helping our clients outperform again in 2025. That'll be the fourth consecutive year in a row. And so if you want to participate in that, join us. And if not, we'll appreciate you anyway. Everyone have a wonderful holiday with their family, and we'll catch you back here on Friday this week. Cheers.